All right, so we are here with section 6.3, which is all about credit cards and store promotions and taking on basically debt and how much it's going to cost you in the long run when you take on debt to pay for things instead of paying cash or paying for that another way. All right, so just going to go through a couple things and then we're going to get into the interest part of it. So, couple of things I will just note here is there is going to be, often on investments, I said this at the end of the last video, often on investments you're going to have a low interest rate. However, on credit cards or any kind of loans, you're going to have much higher interest rates, or what they call finance charges. Finance charges is the total amount of interest paid to borrow a certain amount of money. And so we're going to go through some of these examples here. The very first one, you can go through the example one on your own. That's why it's there. They do use the simple interest formula in this booklet to calculate interest and how much your finance charges are, and this should give you a really good estimate on how much interest you would be paying on, say, your credit card debt if you happen to make purchases on credit cards. Oh, my dog's barking. Come here, boy. And anyway, sorry about that. I'm gonna go on and just do an example here for you. I'm just going to turn over to 307 and we're going to look at example 3. It's a little bit bigger of an example, but it kind of gives you a pretty good idea. So it says Harley used his credit card to make the following purchases during the month. She does not have to pay interest on purchases during the month, only on outstanding balances. Her credit card company charges 8.5. So the way that normally works is if you have a zero balance on your credit card, and then when you make payments, or you get, as long as you make the payment before your due date, you will not be paid interest. However, if you do have previous balances on credit cards, you do have to start paying interest on any new purchases after your previous due date if you carry forward a balance, or if you do cash advances, which is a matter of taking out money from an automated teller from your credit card account, then you do pay interest on that amount fairly quickly as well. But the bank does give you some leeway. If you had a zero balance, you make a purchase, and as long as you pay it by your due date, you aren't paying to borrow that money. So my best advice to anybody young or anybody that is using a credit card or gets a credit card and is using that is to make sure that you are paying off your balance as soon as the due date comes, or before the due date, so that you don't have to pay anything to borrow that money, and then you generate and have a good credit. You're building up good credit. And so we're going to go through this question. So Harley makes a number of purchases throughout the month of November. The interest rate is 18.5%. So then it says, what is her balance due on the statement date November 28th? So I just did this a little bit ahead of time and I added up all of these charges together, and in total it will be $1,207.05. So that is what is due. There is no interest on that first due date. As long as they pay that, you won't have to pay any finance charges. Now it does say the minimum payment is 5% or $10, whatever is greater. So in this case, when I calculate 5% of the amount, if it happens to be more than $10, she'll pay that amount. So let's go ahead and calculate that. 0.05, and I get $60.35. Well, that's more than $10. So we're going to pay, Harley needs to pay a minimum of $60.35. If Harley does not pay that $60.35, the very minimum that is necessary, they will begin to lose their good standing in their good credit standing. So if you ever can't pay a full balance, make sure that you are always paying at least your minimum. Okay, your minimum is usually similar to at least your finance charges for the month. Usually, sometimes it's not even enough. Okay, so if she pays only the minimum and doesn't use the card again between then and the next statement date, how much will she owe on her December 28th statement? So now we're going to do a little bit further calculation. We're going to make a payment, so we're going to subtract that $60.35 off, and we get a new amount of $1,146.70. Now we got to figure out interest. So on that past page, it did say that we would go with the simple interest formula. So the interest charged on that is going to be that principal, the $1,146.70. The interest rate was listed above at 18.5, so 0.185. But now, because we don't know a particular year, we have to break things down into days for credit card payments. So there's 365 days in a year, and we have to calculate how many days is that from the 28th all the way to December 28th. So November 28th to December 28th. So there's 28 days in December. You must include the 28th as well. And you also include the 28th. So there's the 28th, the 29th, and the 30th of November. November has 30 days in the month. That's going to be, some months have 31, some months have 30, and February only has 28 unless it's the leap year. But, so 28th, 29th, and 30th. That's 3. And then another 28 days gives me 3 plus 28 is 31. I may want to just do this quick division or put brackets around it, or actually it really doesn't matter. I could do it at the very end, this times this times this, divided by 365, and I get $18.02. So it costs $18.02 to continue to borrow that amount of money. So I'm going to add that on to the balance, and in total Harley now owes, her current balance is $1,164.72. Sorry about that. There we go. Alright, moving on. This next part does talk about cash advances. I did just make a mention about that. If you take out cash advances, you do have to start paying interest on that amount the day you take that cash advance out. So it doesn't, the banks don't give you as much of a leeway. And even in some cases, some credit card companies will give you a higher interest rate on cash advances because there's nothing saying that you're putting that money back into the economy, things like that. So borrowing cash is going to usually cost you more than just making a purchase on a credit card. So we're going to do another example regarding that. Let's just look at example 4, which is on page 309. So Xavier's credit card charges 24.9%, so a higher interest rate. nowadays, I think most credit cards, well, it really depends on the type of credit card and your credit rating as well. But some credit cards, especially department credit cards, are very high. Whereas sometimes with credit cards, if you purchase like a yearly annual fee plus interest, you can get those lower interest rates. But 24.9 is a higher percentage. Alright, so he uses this to take out a $550 cash amount on December 10th. So, and then the next statement date is going to be the 21st. So how many days is he charged interest on this? So we have to include the 10th and we have to include the 21st. So in my head I'm going 10th, 11th, 12th, and I'm counting through, and that is going to be 12 days. So if I think about like the 10th to the 21st, I'm thinking like 11 plus the actual 10th, that's going to be 12 days. Alright, how much will he owe? Well, we're going to go, interest is going to be equal to $550 times the interest rate, 24.9%, so 0.9 or 249, times the number of days is 12 days out of 365. Do the multiplication there, and you would get $4.50. Nope. Oh boy, no editing, right? And so the $4.50 we would have to add on to the $550 in total. That's how much is going to be owed. Now, a little bit further on this question, it does say what is the actual cost of the cash withdrawal if he doesn't pay it until the 10th of January. So you have two choices here. You could restart over with going from the 10th to the 10th, which would be 32 days, or you could go a matter of the additional 20 days from like the 21st of December to the 10th of January. Either way, you can make that calculation. I'm just going to do the extra 20 days. And 0.249 times 20 divided by 365. Well, that's going to equal $7.50. Then the $4.50 that I added up before is going to be $12. Oh, my dog is making funny noises. I'm sorry. And so then I'm going to add that to the 550, and I get $562. If you have questions about that, you can always just send me a quick message in the chat. Alright, one more type of question. There are some places, some stores, especially like the furniture stores or different stores that often offer different payment plans. They might ask for a down payment on something as well. They might give different promotions like just to make payments and things like that. So you can kind of read through that next little bit, and then we're going to look at one of the examples here. Number 6, I guess. So it says, Sol is buying a new TV. The cash price is $1,675.89. So that probably already includes any taxes in it. However, the store promotion does advertise 24 easy monthly payments of $75. So it's wondering what is the actual interest rate if you have to buy that. So let's consider 24 payments at $75 each. You're going to multiply those together. They are paying $1,800 for that TV. So how much of that is interest? Well, the difference between the amounts is your interest. So I take the price of the TV away, get $124.11. So that's my interest. So if we go back to that formula, interest is equal to principal times rate times time. And I enter the information I know, like the $124.11 is equal to my principal, which is $1,675.89 times the R times the term. So if you recall, we do things in years. So like even when I was doing days divided by 365, I was doing that because of that's like a fraction of my year. So in this case, 24 months out of 12 months is equal to 2 years. Okay, so I can go ahead and multiply those two numbers together, but then I'm going to take them away on both sides. So I have to take it away over here. And times that 2. I could probably calculate that first. Sorry about the squishing that in there. And so it becomes this number divided by, that's about $3,351.78. And when I do that, I'm left with R. So that canceled and that canceled. R is equal to 0.037. Now if I change this into a percentage, so timesing it by 100, I get 3.7% interest rate. And that is it for this section. And so I'm going to leave things there and let you do some of the practice questions, and I will see you in 6.4 video all about personal loans, lines of credits, things like that.